Well, what the HE double hockey sticks is happening in markets today? We just got ISM reads and S&P manufacturing reads that'll give us a little bit of a heads up of some of the poopy doopies that some businesses are seeing out there. And I'll tell you, the headlines don't do justice what is under the cover of what's going on. But on top of this, remember this weekend when Kevin was on a lazy river talking about how we had a bad news event? Remember tariffs being declared illegal? Now it's Monday morning and people are concerned that, if tariffs are illegal, then there's a chance Donald Trump, Donnie T, might have to print some more bonds to fund the government because we're going to have to reimburse all those tariff revenues. Very inefficient should tariffs ultimately be deemed illegal by the Supreme Court and refunds be demanded, which is, of course, leading to ricocheting effects in markets. We can see that the 210 spread is at the highest level of the year. This is not great. It is a shock-style level. Usually we get these sort of big run-ups either leading into or right after a recessionary environment like what we had during COVID, like, of course, what we had going into 2007, like what we had going into the dot-com bubble. These run-ups, not great. Usually the worst, like we become shock-prone over 50. When things get bad is when it's above 1. And there is enough data coming this week that this could be the week we end up shooting above 1. And it's one of the reasons why gold is doing so well. Now, gold not necessarily right now a recession indicator, but gold does have a really interesting history in its relationship with oil. You can see here all these red and green arrows. They really show you there's really no pattern between the spread between gold and oil signaling recession. But what it does do is it tells you that gold or oil are about to probably make a big move. Now, how does that work? Basically, anytime gold gets really, really stretched relative to oil, you get these peaks over here, or oil goes really low. Like over here, oil went negative, so gold looks really expensive relative to gold. It's just a ratio, right? You literally just divide the price of gold today by the price of oil, you get 58. It's very simple. So the question is, what's going to happen right here? Well, history shows you that this spread doesn't stay this high for long. It's going to end up plummeting. Now, why do some people say that's potentially a recessionary tell? Well, the reason people look at this chart is they say, when we get spikes, one of two things happen. Either the price of gold plummets or the price of oil skyrockets, which then narrows the spread. So, like we had a run-up in oil prices over here after the Great Recession, and we sort of normalized on the spread between the two. So we could have a run-up in oil prices, but that seems pretty unlikely, since right now we're seeing a lot of excess supplies being built up, not only in the Middle East, but also more domestic energy production. This leads people to say that gold might end up setting up for a near-term rally. So good news in the near term, especially with this tariff news over the weekend, people selling bonds, bond yields up, going into gold as sort of a flight to safety. But it sets up a potential crash in gold prices going forward to normalize this chart again. Now, why would gold crash? Well, gold tends to crash when a recession actually manifests. See, when people are fearful about a recession or they're fearful about stagflation, we end up seeing gold rise. When the recession actually comes, we know that real recessions bring deflation and then gold prices collapse. Look at the history of gold prices. You usually see gold go up into a recession and down during and out of a recession. So really, gold works well as a recession hedge before the recession. And then people start trading out of it and going into bonds, which then pushes yields lower in that recessionary time as people flee to safety. So an interesting spread to watch that difference between sort of what you're seeing in that gold oil spread and how a lot of things are just setting up for a little bit of a reckoning point. Now, either that's going to be a soft landing or it's going to be a pooper dupers. Look at our last soft landing. Really, the United States' only soft landing was over here in 1995. And you could see that 10-2 yield curve never made it all the way high like it did in the early 90s recession or the 80s or the early 2000s or 2007. We stayed right here where that yellow line is, which is at 60 basis points. Folks, look at exactly where we are right now, 0.63. We're at the same spot. So we are at the teetering point of either we go into recession or we soft land. Now, that's old news. We know we're at the teetering point. But what's happening this week? Jobs data following the ISM and S&P data that we got this morning. So we got to talk about all of these. Take a look at this one. We'll look at this one first. This is the ISM manufacturing PMI report. And some of the commentary in here is wild. Orders across most product lines have decreased. Tariffs continue to be unstable. Tariffs continue to wreak havoc on planning and scheduling activities. The construction industry, especially home building, is still at a lower level. Domestic sales remain flat. The trucking industry continues to contract. This current environment is much worse than the Great Recession of 2008 to 2009. There is absolutely no activity in the transportation equipment industry. This is 100% attributable to current tariff policy and the uncertainty it has created. We are in stagflation. Prices are up due to material tariffs, but volume is way off. Good. One of the reasons why gold is moving up as well. It's stagflationary fears. Very tentative domestic market with home building and remodeling not active at all. We've implemented second price increases, with Made in America becoming more difficult due to tariffs on components. Total price increases so far this year, 24%, only to offset tariffs. No influence on margin. Not trying to make more money, they're just trying to offset tariffs. In addition to that, in 2 rounds of layoffs, high-skilled roles, high-paying jobs, and high-skilled roles are being fired. High-paying and high-skilled roles like engineers, marketing people, design firms, finance or design teams, finance teams, IT teams, and operations are being fired. The Trump administration wants manufacturing jobs, but what we're doing is we're giving up highly skilled and highly paid jobs in favor of lower skilled and lower paid manufacturing jobs. Obviously not good for the economy in the longer term here. With no stability in trade and economics, capital expenditures and hiring are frozen. It's survival out here. The markets we operate in can be strong in the short term, but there's an underlying feeling that has you questioning how long can this short-term boom go on, right? Not great. In addition to that, look at some of this information that we're getting over here when we scroll down. New orders expanded in August for the first time in 6 consecutive months, which sounds great. But listen to this. Despite the move into expansion, for every positive comment about new orders, there were 2.5 comments expressing concern about near-term demand. That's not great. In addition to that, production landed in contraction for the first time since May, and layoffs and not filling positions remain the main headcount management strategies. For every comment on hiring, there were 4 on reducing headcounts as companies continued to focus on accelerating staff reductions due to uncertain near to midterm demand. So think about this for a moment. You basically got all of these companies going, man, like, yeah, things are decent in August. Like, things are like some new orders reads are up. We got the S&P manufacturing has a great headline. Surge in production underpins strongest improvement in manufacturing performance since May of 2022. But underlying, you've got these comments of hell and more comments of bad than good, though some of the good kind of like weighing up some of the bad, right? As we just saw in the ISM. Now, even this report, though, the S&P Global Manufacturing Report, has devils in the details. And this is what we should pay attention to. Because right now you've got the Atlanta Fed suggesting that GDP is growing at 3.5%, which is fantastic and exciting. on early Q3 data. But is it possible that we're really just coming off a summer high of inventory building? And what happens when inventory is fully built and then we have to sell through that inventory? Well, we tend to get a deflationary fall in new orders, which is great because then you end up getting prices coming down again. In fact, think about the potential deflationary forces coming up. I want you to think about deflationary forces here for a moment because it reiterates the direction that gold, not in the near term. In the near term, gold could go to 4,000. But if we continue in this deflationary direction, gold's going to go down. Think about the near-term pressures to the downside for the deflationary forces. First of all, inventory building is deflationary because in order to clear inventory, you reduce prices. Tariffs becoming illegal, deflationary. We'll literally go from transitory inflation on tariffs or from tariffs, right? From tariffs to transitory deflation as those tariffs go away. And then obviously recessionary impetus in markets or in the in economy is deflationary, right? As well as job loss and low job growth / low wage pressures with wages mostly flat is also deflationary. It's not like people are making more. So there's no question over time, rates are going to plummet under these forces. The question is just when? Right now, we're actually in the opposite place where we're still talking about, oh, production's good. Yeah, because of inventory building. Prices are going up. Right, because of tariffs right now. But what happens when those tariffs become illegal? You reverse all of that. It's kind of a crazy whipsawing we're seeing right now. But go into this S&P report for a moment. Look at this. S&P manufacturing, okay? Take a look at this. The headline, if you just listen to CNBC and you just listen to Rick go, that's rate in manufacturing since May of 22. We are just absolutely booming. If you just listen to that garbage on TV, you're going to totally miss the devils in the details. So you scroll into the devil of the details. And what do we see over here? I'm going to go to the first devils, which they bury all the way over here. Take a look at this. Look at this. On the supply side, average lead times improved. Fine. Okay, what do we have here? This. Purchasing activity rose, but only slightly for a fourth month in a row. Growth was noticeably slower than May's record increase. Now, that's really interesting because the headline here is surge in production underpins strongest improvement in manufacturing. But wait a minute. You're telling me that purchasing activity only rose slightly and marginally and was noticeably slower than in May. So how the hell are you going to have a headline that says we had a surge in production, the best since May of 22, the best in 3 years, when you're telling me new orders only grew a little bit, and that we're noticeably slower than in May? Well, there's a reason for this. When we go into the actual commentary from the people who put these reports together, the answer is right here. The upturn is in part being fueled by inventory building, with factories reporting a further jump in warehouse holdings in August due to concerns over future price rises and supply constraints. There you go. So this is an economy that looks like it's booming right now in the summer because people are like, crap, build up inventory. But wait a minute, folks. When new orders are not actually rising, albeit anything but slightly, and way slower than they were earlier, and instead you're bragging about the surge of production because of inventory building, what are you actually doing? You are setting up deflation. This is a huge deflationary impetus that's coming. So again, deflationary impetus number one is inventory building. Number two, tariffs becoming illegal. Number three, any kind of recessionary data is deflationary. And then, of course, the fact that we don't have wage pressures certainly doesn't, it's not, if wages are flat, it's not necessarily deflationary, inflationary. It just suggests that wages are going to be a source of inflation, which is the same thing the Federal Reserve tells us. Now, the only thing that is really bullish right now is what we're going to talk about now. But we know with certainty that the prices
bullish catalyst
of the courses at meetkevin.com and the membership are going to be going up this Friday. So if you are looking for any kind of inflationary sources, it's that Meet Kevin membership with a price increase coming Friday. Remember, if you join, you get my trades, you get all 10 of my next 10 stocks to buy for the next 10 years and hold. We've already bought 3. We have 7 more stocks to reveal. Make sure you're part of it. You get all the courses, all the future releases of data, every private live stream, my historical live streams. You get the alpha report. These could even be a tax write-off for you, by the way, this one-time membership you buy. And you're going to get all of the new lectures that are coming out by the end of the month in the property management course, the the Trumponomics, the tax course, because we're breaking down the big, beautiful bill, what to do for taxes before the end of the year. All of this still coming out by the end of this month, which will be really exciting. So check that out over at meetkevin.com. Now, with all of that said, we've got to talk about what are potentially bullish catalysts on the day or the week. Well, bullish catalysts for the week, jobs. Hopefully, we hope that we can confirm a soft landing, because if we can't confirm a soft landing, then we've got the real pooper dupers. So what are we looking for? We are looking for job openings and labor turnover data tomorrow morning. That'll be coming out at 7 a.m. California time. We're looking for 7.379 million. We are looking for ADP employment to beat 80,000. 80,000's okay. That could be decent enough to get us back to rally, maybe back to all-time highs, maybe some enthusiasm in markets. This morning in the Alpha report, for example, I called the sell-off in the Qs when we were down like 1.8%. I called it overblown, and we had a wonderful boom after the market opened here. Always after waiting 5 minutes first. Wonderful boom. Remember to get that Alpha report every single day. But anyway, ADP is expecting 80,000 jobs. If we can confirm a soft landing, or in order to confirm a soft landing, to actually be bullish, we really need this to be over 80, ideally over 100,000. If we get a 40 or 50,000 read, not great. I'll tell you the standard deviation in just a moment, so you can sort of set your odds expectations for those of you statisticians out there. And then, of course, on Friday, which the ADP report comes out on Thursday, so it's 1 day delayed, which we talked about on the Lazy River this weekend, by the way. Did you watch the Lazy River video? If you haven't seen the Lazy River video, go watch the Lazy River video. It's great. It's like the sinking feeling from the Trump tariff disaster, right? Make sure you watch that. I think it's fantastic. But the other thing to watch is you've got jobs report coming this Friday. Now, the jobs report this Friday, we are looking for 75,000 jobs. So very much in line with ADP. Same thing here. If we get some kind of 100K plus, fantastic, go back to all-time highs. If we end up getting something crap, like 50,000, it's not going to look very good. So we are now looking for an average estimate 76,000. Standard deviation is 50. Standard deviation is 20.8. Most of the estimates are bell curving around 55 to 80. That's where I'd say most of the estimates are. And then there are more estimates to the high side than the low side. So people are optimistic on this payrolls report. That's on the Friday payrolls report. The ADP report doesn't move the market as much. Standard deviation on the ADP report is 20 also. So those are the standard deviations. We got a 92.1% chance of a cut in September, which is also bullish, right? So talking bullish catalyst here. We didn't get NVIDIA as bullish as we wanted, but we do have 2 jobs reports this week, and that's what everybody's going to be paying attention to. In addition to Kevin talking about going to Mario World with the boys, we had a great weekend over here going to the Nintendo Mario World. The kids got the little bands so you can tag and get points. That's actually why Jack's holding an iPad here. So he could look on the iPad and look at the little achievements to see what he's got to get, and they're kind of whacking this. That's why you might hear me say here, let's actually turn the audio on. You'll hear me say you get a bonus if you hit 200. They have all these various different challenges, and if you have an iPad or something that you could give your kids, they can look up all the achievements and the goals, and that's what we did there.
Remember, guys, you get a bonus if you get 200.
So we're talking about the different achievements here, but I mean, this place is just sick. Mind you, it's inside of the Universal Universal California studios over here, and just the fact, I mean, look at the detail over here, like this thing, the rock thing coming down or whatever. This place is so cool, so really cool. Now, obviously, you got the Harry Potter world over there as well. So shout out to this, and this Toadstool Cafe was freaking phenomenal. Really, really enjoyed this. So great. I hope you had a great Labor Day weekend as well. But we went from water parks to Universal Nintendo World, and then did also use to film that right there the Meta glasses, which I did break my Meta glasses this weekend also. Then Amazon overnight delivered a replacement glasses, swapped out the lenses because I may have taken my Meta glasses into the lazy river at Kalahari in Texas. And note to self, water resistant does not mean waterproof. Yeah, so don't do that. I did though, by the way, just anytime I go to a water park or pool with the kids in the future, I did get a waterproof case for the phone. I haven't actually used this yet, so we'll see how it works, but you know, that'll probably be the way I end up filming, because I don't want to carry so much around. Like, you can't carry, you know, GoPros and glasses and phones and all this stuff. Like, you're just gonna have so much stuff. But anyway, so yeah, this gives us a little bit in terms of what's bullish this week. Hopefully jobs. Expiring coupon code on Friday, we know that. Get your alpha report, especially this week. You're gonna want alpha. Then you also have deflationary forces that are going to be really great for real estate in the long term. In the short term, expect rate sensitive stocks to get whacked here. Like, I'll give an example here. I don't know. Yeah, look, Rocket Mortgage today is down 3%. Well, duh. Look at the bond yields. The 10-year skyrocketed. It's up 5-6 basis points today. That's not great for your 30-year mortgage. It actually puts more pressure on real estate in the near term. So you kind of have to think about it like almost like a pressure vat. You know, you're putting more pressure into this economy, and eventually it just blows. That's why we start talking about the 210 yield curve. Once that breaks over 100, that's a sign the valve is opening up, and like the pressure is going poop-a-doopus. And that's not good, because it doesn't give us a soft landing. It probably leads to an unfortunate employment, recession that takes decades to get out of, which will be terrible. But real estate will do really well during that time, not because people will be unemployed, but because rates will come down. And basically, the people with money, the people with the gold, will make more gold, so to speak. So those rate sensitives could be a little bit of a buying opportunity here in the near term as we, lead into deflationary forces coming. They're not here yet. Gold could probably run to 4,000 before it collapses down. That's my take. My take is gold goes to 4,000, and then we have some kind of blow off the, top of this sort of pressure vat, and gold comes right back down, because I don't think that oil prices are going to be up here. Because remember, this is more of a price direction indicator. I wrote this red text right here. Either oil goes up or gold goes down. I don't believe that oil is going to skyrocket here anytime soon, especially if you go into a recessionary environment. History tells you that you're not going to see oil skyrocket because demand will go down. And in a recession, gold ironically goes down. It's really only good leading into a recession. It's crazy. If you study the chart, you'll see it. But some wild information here. As always, remember, use coupon code Catalyst and join us in the Meet Kevin Alpha Reports every morning. Keep in mind, you pay once, you get access forever. So do check that out.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.